What is going on, guys, and welcome back to another very exciting video. In this video, we are going to be talking about Intel. And Intel is not a company that I personally own, but I've gotten a few comments asking me to look into it. So what I want to do in this video is I actually want to go over the steps that I personally go through when I'm first looking into a company. So a lot of what I'm looking at is the numbers behind the business. That is what's really important to me. And then I start diving into some of the fundamentals of what's going on with the market and what's going on with market sentiment around the company. So that is what we're going to take a look at here in this video, a combination of those two things. And that's really what's important to me as an investor. So if you enjoyed the video, make sure you drop a like down below. And if you want to see more videos like this one, make sure you hit that sub button. The first thing I always do when I'm looking into a company is look at their chart, because I want to see, is this stock trading at a value compared to where it's traded at in the past? So I like seeing companies that are going through short-term issues that drive the stock price down. So we could see Intel over the last 5 years, it's actually down 33%. So 5 years ago, it was trading at $51, $52, and now we're seeing it trade down all the way at around $34, $35. So that, for one, is a large move down. The other thing that's important is over this time frame, it kind of appears that the stock's almost traded sideways. So even before we ran into issues, the stock was really kind of just trading sideways, didn't have very large moves up, in the right direction. Every time it did, it really had this large pullback. So we've seen that happen a couple times, so that's also a little bit concerning. But right now we can see they're going through a very difficult time where the stock has fallen from highs here in 2021 to where it's sitting at now. It's down almost 50%. So personally, when I see a stock that is down that much, I actually get very interested. I don't like seeing stocks that are trading at all-time highs. I want to see them have a pullback before I get into it. So Intel right now, it's really not in a terrible spot. The only thing that's concerning to me is that they basically traded sideways for a long period of time from 2018 all the way through to 2021. So the next thing I look at is valuation. I want to buy companies that are trading at a discount, especially compared to the overall market. So what we can see is right now, Intel is trading at a forward P ratio of 119. And in my opinion, the forward P ratio, that's the best valuation metric. It gives you an idea of where the price is sitting at and also where their earnings and EPS are sitting at. So here we have them sitting at 119, and we can see that just a quarter ago, they were trading close to 60. And according to Benjamin Graham, 60 is really the cap that you want to buy a company at, because anywhere above 60, it becomes very difficult for companies to keep up the earnings growth needed to maintain that valuation. So here we can also see that just, 6, maybe 8 months ago, they were actually sitting all the way down at a 14, even down to a 9 forward P ratio. So it seems like there's something going on with their earnings over the last year or so that's really affected the stock in a negative way. So from there, I want to see what's going on with earnings. So they are expected to announce their next earnings on July 27th. And we could see that right now, analysts are expecting them to come in with EPS of -3 cents. So that is one very bad thing. We don't like to see companies that have negative EPS. If we go back a quarter in March, we can see that they were expected to report -14 cents. They actually came in with a slight beat of -4 cents. Again, still not good to see them reporting negative EPS numbers. If we go out to December, we can see they came in with 10 cents. However, they were expected 20 cents. Again, not very good there. September, they actually came in with a relatively strong quarter of 59 cents when they were expected 33. So that's good. And if we look at June of last year, we can see that they actually reported 29 cents when they were expected 70 cents. So overall, a lot of these earnings seem to be missing, and that is a big red flag when you're looking at a company. So those are obviously previous earnings that are in the past. What we want to do is we want to look at the future and what analysts project going forward. So we have for the current year 36 analysts covering the stock, and for next year we also have 36 analysts covering the stock. They have an average estimate for this year of 39 cents of positive EPS. They have a low estimate of 10 cents and a high estimate of 75 cents. For next year, they have an average estimate of $1.74, a low estimate of $1.02, and then a high estimate of $2.75. What's interesting to me about these numbers is the variation that we're seeing. So the average estimate for this year is sitting at 39 cents, and then we have a low estimate all the way down at 10 cents and a high estimate all the way up at 75 cents. That is a little bit concerning because it seems like analysts aren't really sure what is going to happen with the company because of the wide range that they're putting in there. And that continues into 2024 because we see a low estimate of $1.02 and the high estimate is over $1.50 greater than the low estimate. It's sitting at $2.75. cents. So again, a very wide range in estimates, which is a little bit concerning because it just speaks to people not really understanding whether the company is going to be very profitable or not very profitable. I always like to confirm some of the PE ratios on Yahoo Finance. So we can see for 39 cents, the PE ratio would come out to 88. For 10 cents, it would come out to 344. And for 75 cents, it would come out to 45.95. Things get a little more promising when we plug in 2024 numbers. So for the average estimate, we actually get a PE ratio of 19.8, which isn't terrible. That's actually below where the market's trading right now. If we look at the low estimate, it's currently trading at 33.78, which again isn't absolutely terrible. It's not bad. And if we look at the high estimate for EPS of $2.75, we're actually trading at a PE ratio of 12.53, which is a fairly good deal. So here we have a website called Macro Trends. And personally, I love their graphs because they are a very good visual representation of how the company is doing. So what we can see is back in March of 2022, they actually peaked out at a trailing 12-month earnings of $6.02. And on the quarter, they came in with $1.98 of positive EPS. That is a very good quarter. But right after that, they drop all the way down to negative 11 cents in EPS. And they have had a few bad quarters over the last year. And that overall has sent the stock down in a massive way. So what happened around a year ago that really caused this stock lower? We can go back and look at their earnings report from July 28th of 2022. And they announced that revenue actually went down 22% year over year. They also had that GAAP earnings of negative 11 cents. That's concerning. And what we can see in here as well is that they had issues with client computing, data centers, and their AI group, which really impacted overall how the business was doing. The CEO also came out with this statement. This quarter's results were below the standards we have set for the company and our shareholders. We must and will do better. The sudden and rapid decline in economic activity was the largest driver, but the shortfall also reflects our own executive issues. We are being responsive to changing business conditions, working closely with our customers while remaining laser focused on our strategy and long-term opportunities. We are embracing this challenging environment to accelerate our transformation. So when I read a statement like this from a CEO, it's a little bit concerning. And the reason for that is because of how broad the problem is. He basically just says that economic activity is causing the decline in the business. And for me, if I were a shareholder, I would not like that statement. I want to see exactly what the problem is. If it's chip sales for computers, I want him to say that that is the issue and how they are going to address that problem. Because when you define a problem, it is a lot easier to solve it than if you make it a very broad problem. The way this statement reads is almost like Intel is waiting for the Fed to step in, lower interest rates, and that's going to help their business. But at the end of the day, they can only control what the business is capable of, and they are not going to control interest rates. They need to have a plan going forward of how they are going to help get revenue back up and get EPS back up. And in my opinion, it actually looks more like a competition problem. So what we can see is the revenue again is down 22%, which in my mind leads me to believe that people are stealing their market share. We are also seeing gross margin go down. So it is down around 20.6 basis points. It was at 57% and it's down to 36.5. And then we also see their operating margin actually fall into the negative at negative 4.6 from 28.3. The other big comment on here is what I highlighted in red. So the company generated $0.8 billion in cash from operations. However, it had to pay $1.5 billion in dividends. And that statement around a year ago actually alludes to what happened more recently here in May. We can see that the company cut their dividend from 36 cents all the way down to 12 cents. One of the reasons I think they might be having a slight competition issue is we can see that back in 2021, they capped out here at a revenue of around $79.02 billion. However, since then, it has fallen all the way down to $56.4 billion. And the reason I think it could be a competition issue is when you look at NVIDIA's revenue, we can see that they capped out here around $29.7 billion, and they have fallen, but at a more slight scale, only down to $25.8 billion. And if we look at their most recent quarter, they actually saw a large move up from around $6 billion up to around $7.2 billion. So personally, when I look at a company like Intel, I am not interested right now. There are some things though that could change that could make me interested in this company. The first being I want to see them increase their revenue and get back to positive EPS. If we start seeing them trend towards that $2.75 in 2024, that would be a very big positive. But I also want to see the stock price fall slightly because there needs to be enough premium to the upside for me to be interested in the company. And what I would like to happen is to see Intel actually fall back down into that $25 to $30 range. We actually saw it hit that $25 mark 3 times, and each time it bounced off there. So it seems like there is a lot of buying pressure in that $25 to $30 range. And if we were to go back down to that level and then us also see the business economics change, I think that would be a potential buying opportunity. One thing I always got to throw in here is do not buy a company just because some random person on YouTube talked about it. Make sure you are doing your own research and looking into companies that meet your risk tolerance as well as your time horizon. So with all that said, I hope you enjoyed the video. If you did, make sure you drop a like down below. And if you want to see more videos like this one, make sure you hit that sub button. And as always, guys, have a wonderful rest of your day.